Hello, I'm Alan Miller. For over 25 years, I've worked as a fund manager running some of the most successful investment funds in the UK. I have always taken my responsibilities very seriously. When I used to buy individual shares, I read piles of research from different experts and saw many chief executives from many different companies. This was my quest to find tomorrow's winners, the needles in the haystack. I had a reputation for asking the tough questions you weren't meant to ask, as I never gave up until I understood how the company really worked or why exactly it was going to make my investors any money. This often made me very unpopular with chief executives. But we're in a different world now, and I believe those days are gone forever. The investment industry likes to bury its head in the sand and pretend the rules and the odds haven't changed. But things have changed, and dramatically, in terms of volatility, market efficiency, returns, and costs. In a low return investment environment, it's harder to find performance, and when you do, the layers of intermediary costs, many hidden from investors, eat up the returns. Living in an information sharing world has dramatically changed the rules of fund management. In the past, key financial information was only available to a few. Now it's available to everyone, and normally at the same time, thanks to the internet, resulting in something called information symmetry. More information and better information allows markets to become more efficient in terms of their pricing of these future expectations, making it much harder for even professionals to now beat the market. The edge is reducing, so to find positive returns for clients, you need to dig deeper, be smarter, work harder, and focus on what can be controlled. Today, cost matters even more. The fund manager can no longer win at the expense of the private investor, since the private investors only hold a small amount of the market these days, so they can only win against each other. In fact, the vast majority of managers fail to outperform the markets even before those fees they charge. And the few that did outperform the market before fees then pocket most of those profits in high fees, leaving the investors out of the cold. The higher the cost, the more investors are likely to lose. Research shows that only 1% of managers beat the market with any meaningful degree of consistency, and that it's almost impossible to identify them in advance. Did anyone tell you when Warren Buffett started his first investment partnership at the age of 24 that you should invest with him? When you give your hard-earned money across to most fund managers, you're really just buying a lottery ticket. But the fund manager simply forgot to tell you. And what about those fees and charges? Many of which are buried in the small print and which are a massive drag on investment returns. One amazing fact is that the real return after inflation from shares over the last 113 years has been just 5.2% per annum. If it's costing you 2 to 3% plus per annum to access this return, you might ask, what's the point of investing? The effects of compounding mean that over the years, investors are paying a small fortune into someone else's pocket. So if the rules have changed, why hasn't the industry changed? Well, we invest differently from most investment companies. We don't tend to make huge changes every month, but small, cautious changes. And sometimes we do the hardest thing in fund management. Nothing. i.e., we keep our strategy the same unless there's a significant benefit from changing it. We also do the next hardest thing. We make up our own minds on what to invest in rather than simply following the herd and whatever is the latest investment fad. We look at the odds. What is the best chance of making money long term? In the past, it's often been in small companies or in value stocks. but you still need to know the right time to access this growth cheaply, or you won't make any money. I never forgot being told by a boss that performance doesn't come in a straight line. He was right. That's why we're not wedded to anything except trying to make money in a consistent way, but without taking excessive risk. We believe you can't guarantee success, but you can improve your chances by focusing on 3 things. Firstly, reducing the cost of investments. Secondly, increasing the spread of investments to reduce risk, called diversification. And thirdly, being contrarian, which means making decisions that often are unpopular or unfashionable. So why do we only invest through exchange-traded funds, also known as ETFs? Cost is the most reliable indicator of investment returns. That's why we only use ETFs, as these are incredibly efficient and low-cost index funds. They also often have the advantages of being better spread, less volatile, and more liquid. These ETFs don't invest in individual shares or bonds. They invest across the whole market. Because indexes are better spread, they are normally less volatile, meaning you're less likely to panic at exactly the worst time. Remember, fund managers are human, and they can often be emotional. One of the reasons why so many fund managers do so badly isn't just about what they bought, but when they bought it. So in a nutshell, we offer simple but smart, common sense, modern investing based on practical experience and robust research. Thank you.